Hello and welcome to the Harwood Report for May 7th, 2018, presented by Trade Academy. I am your host and the founder of Trade Academy, Keith Harwood. Normal disclosures: all services and content are provided for educational and informational purposes only and are not intended as legal or financial advice. All right, folks, it's been an interesting week. The market is testing a breakout of a wedge, and then the key is as it presses towards the next 100-day moving average, what happens next. That's for SPY. Qs and IWM are actually in a little bit of a different spot here. I'll talk through a little bit of that. Seems like really Apple kind of saved the market, and it's not just Apple, it's Warren Buffett talking about Apple. Apple had good earnings, and then the market didn't really rally until Warren Buffett came out and said, I bought 75 million shares of Apple. And that confidence seemed to start putting some money back into the market overall. Talk a little bit more about what I'm thinking about going forward here, particularly in gold and oil as a really big one because of what's going on with Iranian sanctions right now. Those, if Iran gets new sanctions put back on them, that seems like it could really strike the price of oil higher. Is that already being priced in? I'm not sure. It might be. But is it already being priced into oil producers? That's the big one. I think that there's some real opportunity there in XLE and OH, and I'll talk through that a bit as I go through each of these ETFs. Fear is still 43, and like I've said before, this is not accurately representing the fear being priced into the market. And the reason I say that is that the greed is coming from junk bond demand, which, there it is, this line right here. This spread is still historically high. So if you go on a long-term basis, this would show fear, not extreme greed. That's not indicative of a greedy market. Again, difference in 20-day stock and bond returns, yes. Stocks have outperformed over the last 20 days, but this has been chopping here. This doesn't look like greed to me. This looks pretty neutral given the sort of chop overall. And then I go down to the fear indicators. The S&P 500 is a little bit below the 125-day moving average. I think the 100-day moving average is going to be a little bit more crucial. If we get above that, that will start to show a little bit more greed. Let's change the put-call ratio. I'm an options guy. I want to see more calls trading, fewer puts trading. And I want to see some of these new 52-week highs really get formed. So there are a few equities starting to make new 52-week highs, particularly in the oil names because of the oil strength. But it's not becoming a global buy the market situation. When all stocks start pressing back towards 52-week highs, that becomes a potentially overbought situation, but it's not necessarily a fight of the trend. Right now, the trend is non-existent overall if these things are neutral. So there's no trend right now, which I think is probably pretty indicative of what's going on in the chart. So let's go to that chart. S&Ps, you can see there is no real trend here. It's been chop. Really, the key for me is this pink line is the 100-day moving average, and this pink line is the 200-day moving average. So let's not look at that thing. We see that it comes back to the 200-day moving average, goes up to the 100-day moving average, back to the 200-day, a little brief stop at the 50, which is where we're at right now. We press through that, again, back to the 100-day moving average. There's also a wedge formation that a lot of people have been talking about. It looks like we're about to break out of that. See this sort of downtrend line there. I can draw it on here if you guys want to see it a little bit more clearly. But I take a little line right here, and you can see we're basically testing the upper end of this line where we tested a little bit above it briefly back in March. So if we continue higher to the 100-day moving average, a lot of people are going to be talking about the breakout of the wedge. I think that there are two keys. We got to get above that 100-day moving average as well as above that wedge. So really the 100-day moving average, I think, is kind of that final, I have conviction we're going higher play. Breaking out of the wedge gives us that little oomph to just obviously get that last $3. So, basically what I'm thinking is if we get up 50 cents, we should go up $2.50. It gives me a little bit of a short-term target. If we can't get up 50 cents, then I expect to see us pull back at least to 263.5 and more likely back towards 261.5 and see if that 200-day moving average holds again. So as this wedge forms and tightens and tightens and tightens, eventually it breaks out. If this is the final breakout to the upside, the 100-day moving average gets taken out and we'll press back into the 280 range probably over the course of the next month. Or at least that's how I'm going to be looking to play it. It's not saying that you guys should play it that way. That's just the way I'm looking at it, obviously. So that's been my focus, is how I want to play that. Why don't I take you straight to the options on SPY and we can talk through a way to play for that little move where we're at right now. So first off, on the vol basis, we're getting now down to a point where vol's not all that expensive. Yes, vol can get lower. We know IWM vol is cheap relative to the S&Ps. I'll talk about that more in the premium newsletter that I'll be posting in a little bit. But right now, SPY is at kind of a local low here. The March 9th low in vol was just above 11. That's not the March 9th low in VIX. So if I look at this on a VIX chart, we can see that the March 9th low in cash VIX, where's March 9th here? This is going to be March 9th over here. March 9th low in cash VIX was 1444. So we're actually, we're just basically really testing that level to see if we can get down to a point where vol is getting cheap. And because vol is already at these kind of low points that were being driven from higher prices, it seems like the market really wants to press that higher value. When I look through the term structure here, I really kind of like being in this May 29th type stuff at 11, or just under 12 implied vol there. Yes, vol can get lower, but if I try to structure something that's really taking advantage of this this calendar basis, where May 16th is almost 13 vol, and I can get 12 on May 29th, while realized vol has been between 12 and 13 recently. Yes, it was higher longer ago, but it should start coming down if the market is going to go back into a bullish scenario. I kind of want to have a grind higher. I don't want to have a lot of theta. And what I look at is I look to buy something near the money here, even the 269s, which these aren't necessarily the ones that are going to make me a lot of money on a rally to 270. These are the ones that make me a lot of money on the rally through 270, pressing through the 100-day moving average. Well, how do I reduce my risk in case the 100-day moving average is the stopping point? I just come back to the May 18th, and I sell some 271s against it. So here's the idea. I'm buying 12 vol. Yes, I'm selling 12 vol, but on something that's a little bit lower probability because it's got some resistance at the 270 line. If it presses through and skyrockets, the spread goes to $2, the difference in the strikes. If it takes time, I make more money than that. And initially, I'm getting in on this at about $1.50. So if a skyrocketing market happens, this goes to $2. So I make 30%. If a grinding higher market happens and we stop at 271, these 269s are still going to have some extrinsic value to them. They're probably worth something closer to 3 at 271, 3.5 at 271 in 2 weeks. So that gives me some time to see how this plays out. I can show you a risk chart as well if you want to see a little bit more, because this is a little bit more of a complicated trade here with a diagonal. And I'll tell you right now, I'm going to show you another diagonal a little bit later here, so I don't want to scare you, but I'm just going to use a little bit of time here. We'll go out to May 14th, so a week from today. What does the P&L look like in this trade? You can see it's got a nice little kind of curvature up here with the optimal move basically up to right around $272. So it doesn't have to stop at 271 to maximize my P&L. If it goes to 271 and then sits there for a couple of weeks, that's great. But if it goes to 272 next week, I've still got a long delta here on the way up. And a nice little risk-reward profile over time for that grinding higher, retesting the 100-day, and even if it presses through, I still make money. That's why I like this kind of setup right here with this vol low. All right, let's move on here. The Qs are really the driver the last 2 days. As we know, Apple was a big mover. Apple's at new all-time highs. Buffett bought a lot. Great. That helped bring up the market. It helped bring up semiconductors. It helped bring up the tech names. The tech name high on April 18th was 167. Right now, we are at 166.72 on the high for the day, a little bit lower than that right now, 166.5. If this breaks out above 167, I think that also helped make sure that the S&P wedge breaks out to the upside. This is going to go kind of hand in hand. If that happens, I don't see a clear stopping point until we get basically up to 170 in the Qs. Well, 170 in the Qs seems like that should help get the S&Ps above the 100-day moving average. So let's just, kind of putting all the pieces together. If the money flow into the Qs presses the Qs up above 170, that should press the S&Ps up above the 100-day moving average. Still works well for that diagonal I mentioned. But if the Qs are going to be the leader, 170 makes a lot of sense here. It's the previous high. Yes, we had some trade above it in March, but I'm really more focused on the January high and then the subsequent February high than the March high, because these two are going to be looked at very aggressively in the other indices. If I go to IWM, I see a similar sort of setup, pressing towards highs. IWM has been lagging the Qs a bit in this last portion of the rally, while it was holding up better on the dip. The money was going into IWM on the dip, not into the Qs. Now it's going back into tech names. But IWM is still going to be along for the ride. It's just not quite testing that April 18th high yet. Qs go to those highs, IWM goes to 160, if not more. The spread between the Qs and IWM has ranged between about even money and $17 on the highs when everybody was really obsessed with tech and really nervous about the market as well. So, kind of in this March range, tech started getting all that. Tech made that new high that I showed you. So if IWM is going to be the leader, it needs to get a little giddy up going. Right now, it seems like, while last week it seemed like IWM was going to be the leader, right now it actually does. It's rotating my theory, thinking back to tech being the leader. I don't know that tech is going to get more than $12 above the Q, above IWM from its current level of about 9.5. So IWM still has to run here. It should be pressing at least 158, 159 on the Qs to 170, and probably a little bit more. I mean, if we get this kind of move, I think people are just going to get excited about buying everything. And the most leveraged leader tends to be the small caps, which is seen in IWM. Finally, I'm going to go to TLT here from the sort of equity macros type side and show you guys that it's not doing anything clear. I've been looking at TLT as a play for a long straddle because at some point this is going to move, but it got to go longer term. So in the past, I was looking at the July straddle. I might even go longer now because the vol's cheap. I'm going to talk about that more in the premium newsletter because right now, that's not the big money trade. It's just a really good back pocket trade to me. We've got to see how things are managed in the macro environment and then get back into the rate hike discussion. So if the market continues to firm, they're going to start talking again about more rate hikes. That's going to press TLT lower and press it through this 117 level. But in the meanwhile, there's no clear trend here, so I can't trade it off of a technical basis. I have to wait for the equity market before I can really get aggressive with the rates market because the Fed still wants to basically give you that Goldilocks scenario. Well, if the equity market gets weaker, don't worry, we won't raise rates. And if the equity market gets stronger, yeah, we'll raise rates because we'll take that opportunity. Well, then we got to get out of this range, this chop in equities in order to get out of the range and chop in rates. So I think that equities will move first, rates second. That's why I was looking at those deferred straddles in the TLT market. I want to move to gold because I think gold is getting a little bit more interesting again here. So dollar yen has been my key, right? And dollar yen has been trending higher, but now we've got a MACD cross happening on the daily. Doesn't necessarily mean we get a pullback, but we're also below the 10-day moving average. Seems ripe for a little bit of consolidation, and if it can't press higher, if we can't get more dollar firmness, everybody on TV is talking about the dollar bounce back and how strong the dollar is relative to the yen. That sentiment may put a little bit of pressure on the dollar and a bid the gold. On top of it, we've seen oil rallying. We've seen this concern with what's going on in Iran, and I don't think China tariffs are necessarily bullish or bearish gold. It's more about what happens to the risk-on, risk-off environment. You can also have gold rally with equities. It's a zero correlation, not a negative correlation. So when people sit there and complain that gold is up when equities are up or gold is down when equities are down, that's perfectly natural on a zero correlation product long term. In the short term, they may inversely correlate or positively correlate. If inflation's happening, both tend to go up. If there's something going on with rates, maybe they go in opposite directions. But right now, this 109.20 level is kind of key because we're sitting. If we get back above the 10-day moving average and we start to push back towards continuing the trend, obviously we've got to clear the 200-day moving average in order to sort of convince people that there's a real uptrend in dollar yen. And if that starts to happen, it's really bad for gold. Right now, it's in a chop spot. So I look for a little clarity here. Well, first off, gold being in this chop spot is pressing against these lows. When dollar yen was here last, we were looking at gold a couple bucks lower. So gold has gotten a couple dollar bid, and I think that a lot of this is due to investment flow. So we've had money coming into the commodity sector, oil in particular. People are looking for non-correlated or inversely correlated hedges to their portfolio of equities. Equities worked really well, just long equities and ignore commodities for a long time. Now commodities are getting back into the focus. So that's naturally going to stop gold from breaking too fast. But if gold starts to break and gets below 121 and in reality below 117, that could create a massive washout again, because all these people that wanted gold all of a sudden see that that was a really bad portfolio rotation decision, and they create a bigger washout. In the meanwhile, my current bias in dollar yen has to be that it is consolidating before another leg higher, which is a little bit bearish for gold. So consolidation before a break. So how do I play for consolidation before a break in gold? Let's pull up gold vol. Gold vol, 9% is very cheap, 11% is expensive, 12% is very expensive. Right now, the market is trading off of that consolidation. Yep, sorry, I rechecked that. So trading off that consolidation, pushing the vol lower, but it's got a little bit of a bid today that's sort of irrational to me. How do I play this out? I just do a simple calendar. Because if I go to June 1st, and I do this very similar to what I was looking at in S&Ps, I take a 124 put here. And I go to May 18th, and I sell. Now it seems cheap, but the 122.5 put at 17 cents. Makes some sense here. And I look at the positions on this trade. I'm buying 8.75% vol. That's incredibly cheap. And I'm selling 9.5% vol. That's not that cheap. Realized vol has been under 9%. I don't need to own 9.5% vol. If this breaks down, it's worth $1.50. It's currently trading at 72 cents, I apologize. So that's a double if gold really breaks. And if gold sits, I don't have to pay any theta. So I've got a short delta position to play for the break eventually, but I don't have to worry about it if we consolidate for a couple of days. So again, if we consolidate here around 124, 123, 125, I'm not really going to get hurt. Sure, if we wash down to 121.5, I'll wish that I didn't have that short put that expires in a week and a half, just about 2 weeks. But I'm also going to be doubling my money, so I can't get too upset about that. So right now, you're starting to see the trend here, right? We're getting into this sort of diagonal trade, allowing the fact that there's some front month option volatility bid as a way to reduce the theta bill, because some of these names seem to be kind of going into grinding mode as opposed to into spiking and running mode. A trend higher market is great for a diagonal. A chopping up and down market like we saw here, oops, go back to SPY. This chopping market where we're doing this, and especially this, was better for long straddles. We still had some long straddle kind of plays coming last week, and now if this wedge breaks out and we start to just grind higher and go back into this kind of mode, a diagonal really works. Here, it just was long short-term options because we ran so fast. But when you're doing this kind of slow trend up relative to the implied volatility, that's good for long diagonals. And as this realized volatility has been below the implied volatility of the very front end of the curve, I think that's kind of the way that I'm looking to set stuff up, is more with diagonals. And for gold, it's a short diagonal. Silver is very similar to gold. I will talk a little bit more about silver in the newsletter because it's a little bit funky, as it's just basically sitting here. This may be more of a wait and see mode. Once gold breaks out, then silver can break out. So if gold falls below 124, below the 200-day moving average there, then silver looks like it really wants to press down here, sub 15 down to 1475. If gold goes the other way, silver goes right back to 120 or back to 16 and a half-ish. Similar maybe to TLT, where TLT I think is going to be waiting on equities to get its decision. Silver is going to be waiting on gold to make its decision. And I always just touch on the miners because they are obviously related. If gold falls, the miners need to get weaker. And volatility in the miners is very cheap, so I'll look for ways to play that to talk about in the newsletter. All right, finally, I'm going to look over to USO. We see that amazing firmness in oil. This is all built upon expectations with Iran. That is firming the markets. One flag for me is the euro. So generally, traditionally, oil has a positive correlation to the euro, and you can see the weakness in the euro here. It's a longer-term correlation, not a day-to-day correlation, and right now USO has an outside factor, outside of currencies, that is driving its movement, and that's Iran. That is the dominant factor. But once the Iran decision is made and oil moves off of it, then the inputs start to focus back on the currencies and where people can get their hedges and where these companies are going to be making their money. That's the flag for me right now, is that the euro may, if the euro continues to be weak throughout this week and doesn't bounce back before the Iranian sanction stuff, may become a problem for oil. That said, right now I can't fight the trend. Oil has been going higher, and every time it pulls back, it gets bought up. So maybe the euro, all it really does is helps pull oil back down to the 20-day moving average. Yeah, 50 cents, that's 3%. That's $2 for CL. I was talking about CL a lot last week for the $70 marker as well. There's a big psychological element of being above $70. And you know what happened? As we got above $70, OIH popped. Because now we're above that psychological barrier. People thought there's no way we can get above 70. Now that we're above 70, everybody's talking about it. That puts OIH a lot higher, and it puts XLE a lot higher. And these are the two that I normally focus on, but you can even see it in, XOP, which is at highs. So that one's really done well. Note where that is relative to XLE. XLE is still below the January highs, and OIH is still below the January highs. These are oil services. XOP is exploration and production, and XLE is just general energy. AMLP is another one to just watch here because that's still lows. That's the midstream stuff. I don't focus on that for you guys right now because it seems like that's the hardest one to get right, honestly. So why not focus on XLE, which looks like it wants to run higher. If oil is at these ridiculous highs they haven't seen since 2014, why isn't XLE getting a better bid? Is it because ExxonMobil had bad earnings? Maybe. You know what? ExxonMobil having bad earnings doesn't necessarily indicate forward earnings that can happen if oil stays up here. They can get hedges on at higher levels. And of course, OIH has been my focus because that's where I think there's a lot more explosive potential here. 31 easily in the cards if oil stays up here. So let's talk about OIH. If 31's in the cards, but I'm a little bit worried about the euro, and there may be some consolidation here near the highs, around 29 and change, and the vol is near lows, but starting to bounce here. 25 is very cheap. 31 is very expensive. 28.5 is kind of in between, but the historical volatility has been low. So I'm already seeing that low historical volatility. Yes, we had a little bit of a breakout today, so that'll help bring up the historical volatility because this is 1% a day, and today we're already at 2.5%. Show you the position I already was looking at, but I'm going to show you again how I construct this. So I look here, and actually I'm going to change it a little bit because the June 1st fall is now a little cheaper than the June 8th. So June 1st fall, 26%. That's pretty cheap. It's close to that 25% low. June 8th fall is about the same, to be honest, but we'll go with June 1st here. 28.5 calls. A little bit out of the money. On a run to 29.5, these things are double. If it stops at 29.15, these things don't. They're up, 20%, if that takes that much time. If it happens quickly, of course, these increase in value quickly. So, $1.20 higher, these are probably worth about $1.15, $1.20 if it happens tomorrow. So very nice return. Now, if this all takes time, then I need to have a short leg against it. And so I actually looked at the May 25th, 29.5 calls, 27 vol. Or now, because these are a little bit cheap here relative to the curve, you can do 27.5 and 27.7. I'm actually going to go higher and go to the 30s. So I changed my structure as I see a little bit of change to the skew. I mean, I did my first idea half an hour ago. I changed it now. And the reason I change it is because the market is allowing me a little bit of a better entry on something different. So what do I got here? I've got this diagonal that if the market really just explodes and OIH goes to 31, this goes to $1.50. It goes to the difference in the strikes. Both of these basically convert to a stock position. Right now it's 42 cents. That's giving me a lot of leverage. I normally don't like having a short leg in OIH because of the potential exciting upside there, but right now this is giving me a lot of leverage with a short leg that allows my theta to be 0 again. So if we continue to grind higher and stay at this low realized volatility, I still make money. I'm cheapening my option by selling something that's unlikely to occur, and it's probably overpriced at 11 cents. All right, folks, I talked through a lot of those things there, obviously a lot of names, and I want to go now from this to the premium product, and I want to reiterate, and I said this last week, this is the final day that I'm going to give you guys a month for free. Tomorrow at this time, it's only going to be 2 weeks. Okay, so I'm changing this number. It's no longer going to be a month. A month has been too long. I've given a lot of people that opportunity. So you got to act now. If you want to get a full month for free, act now. After that, it's only $49 a month, so it's actually still very cheap. And I give you a lot more content. I give you a Wednesday midweek update. But it's going to be 2 weeks for free starting next week, which is still, or starting tomorrow, which is still a very good deal to get 2 weeks for free. Get anything for free is a very good deal because free is free. Information for free is a nice thing. So I urge you to sign up now, tradeacademy.co/Harwood Report. And sign up quickly because tomorrow this offer is going to be gone. So on May 8th, the price will be the same, but it'll be 2 weeks for free. You can email me, keith@tradeacademy.co, or call me 312-600-8004. Thanks again, everybody. Have a wonderful trading day.